All right, folks, the last mini unit in the accounting is in regards to financial analysis. Now, we know that from the definition of accounting's the process of gathering, recording, organizing, and the last part is analyzing financial information. So we've done the gathering, the recording, the organizing, and now we're going to analyze the information. All right, and we're the whole purpose of financial analysis is to provide financial information for decision making. Now, analysis of financial records allows management to compare different periods to determine trends and changes, both positive and negative, and then to take advantage of positive trends and to minimize the effects of negative trends. Now, who's interested in this information? It could be management, it could be investors, bank managers if we want to get loans. Okay. Now, the first part of financial analysis we're going to talk about is trend analysis, or analysis of comparative financial statements. And all that means is we're going to compare the financial data of the same company for 2 or more years. Okay. Now, accountants look for extreme changes in account balances because management may want to correct weaknesses and take advantage of strengths. Okay. And a condensed statement, okay, is simply a financial statement only looking at the key figures. So here's a condensed income statement. So you'll see net sales, cost of goods sold, gross profit, operating expenses, and net income. And you'll see from 91 to 94, okay, we see the net income dropping from 16,000 in 1991 to 9,000. Okay, so what's causing that to happen? So if we look, our net sales are increasing over that time period consistently. Okay, but we're still seeing a drop in net income. Okay, now what could be causing that? Okay, one thing is you'll notice that our cost of goods sold have steadily increased over that 4-year period from 50,000 in 1991, okay, to 85,000 in 1994. Okay, but we also see that our expenses have also increased over that same period of time. Okay, from 35,000 to 47,000. So those are the two reasons why we're seeing our net income drop. Okay. Now, people who use condensed statements, okay, to make analysis often compare changes in percentage terms. So what we're going to do is we're going to convert those numbers, okay, to percentage terms, okay, in addition to looking at the dollar amounts. Okay, so we just looked at the dollar amounts now. Now, if we convert these figures to percentages, it may help clear up the picture for us. Now, when this is done, net sales is converted to a base figure of 100%, and all other amounts are converted to a percentage of net sales. So it's similar to calculating your average. Okay, so net sales is going to be our base figure, 100% in each year. Okay, and what I'm going to do is I'm going to give you the same table, same numbers, and beside the numbers I'm going to put the percentages. So here we go. Okay, so this is exactly the table from above. Okay, but now there's percentages. Okay, so all we've done is we've taken 101 divided by 101 is 100%. Then 50 cost of goods sold as a percentage of net sales. So 50 divided by 101 is 49.5%. Okay, and we convert the other figures. Okay, and we do that for each year. Okay, so you'll notice that net income as a percentage of net sales went from 15.8% to 6.4%. Okay, and you'll notice that we said cost of goods sold may be our issue. So it went from 49.5% to 60.3%. Now, if you look, operating expenses actually went down as a percentage to net sales, because in 91 it was 34.7%, but in 94 it was 33.3%. So really, operating expenses are not our issue. Okay, the issue is cost of goods sold. So how do we alleviate that problem, right? Well, we can find new suppliers, right? We can produce with cheaper goods, okay, so cheaper raw materials. Okay, we may have to consider manufacturing overseas, okay, to reduce our salaries, okay, because labor is cheaper abroad. Okay, so again, once we convert to percentages, the picture becomes a little clearer. Okay, so we know that operating expenses was not our problem, because as a percentage of net sales, it actually dropped. Okay, and cost of goods sold is our problem, because okay, it has steadily increased, okay, over that 4-year period. All right. Now we can also analyze a balance sheet. Now, a condensed balance sheet, okay, includes totals for current assets, current liabilities, long-term liabilities, and owner's equity. Now, when we're using a condensed balance sheet, total assets is used as a base figure when converting the assets to percentages, and total liabilities and owner's equity is used to convert liabilities and owner's equity figures to percentages. All right, so hopefully that helps and you understand it. Okay.